Welcome to Yahoo Finance's Morning Brief. I'm Julie Hyman, joined today by Yahoo Finance's Ines Ferre and by Kevin Munn, Hennian and Walsh CIO. Thanks for being here, guys.
My pleasure.
So we have a lot to talk about here this morning. We've got futures that are trading higher, and people are digesting what we heard from Kevin Warsh in his first meeting yesterday. We are also digesting that indeed the U.S. has signed this memorandum of understanding with Iran. So sort of some different forces at work in the market. But I do want to dig into the Fed a little bit because it was a big deal. Kevin Warsh's first press conference. We don't know for how many more of those press conferences we're going to get. In fact, we know very little, except that he has task forces to work on a lot of different items, and maybe at some point we'll get more information, but also that he's not giving us sort of forward guidance as to what the Fed might do next. Ines, we've been covering the Fed for a while here together. The market, in the absence of more information, assumed hawkish.
Yeah, and they assumed hawkish, and they assumed that this was definitely a bias towards a more hawkish tilt. But I think that the bottom line is that from that presser, from his responses, it just seemed like, I'm going to shake things up. I'm shaking things up here, and we are going to create these task force, and don't expect things to be the same as before. And the bottom line to me was also that they are going to be looking at data that's different data, real-time data, and perhaps I think this is actually bullish for the market, because I think that this means that, look, we're not going to perhaps look at this backwards data from before, perhaps PCE. Maybe they're going to be looking at a trimmed version of PCE. Maybe they're going to be excluding things so that it shows that inflation is somewhere where maybe it tilts more favorably towards inflation. Yeah. That to me was what I got from, even though you saw the market responding, thinking this is more hawkish, maybe there may be a rate hike this year, but at the end of the day, I didn't think that that's really what he was saying, telegraphing. I think he was telegraphing something else, perhaps.
Yeah, it was clear to me that Kevin Warsh signaled there's a new sheriff in town. Yeah. There's going to be new operating rules for the Fed going forward, perhaps not immediately, but through these task forces, perhaps over time. What I found most interesting is that he actually encouraged the other 18 voting members to supply dots on the dot plot charts to update their summary of economic projections, even though he did not. He abstained from any such dots or forward-looking projections themselves. And yes, they did forecast one potential rate hike this year, but they also forecasted one potential rate cut next year. And if you look at the dot plot chart, and perhaps we're not going to be able to talk about the dot plot chart that much longer, so let's do it today. You had 9 of the voting members forecasting around one rate hike this year, 8 other members forecasting nothing with interest rates this year, and 1 final member forecasting 1 rate cut this year. So there's no unanimity there. So for people to come out of that presser and out of that meeting thinking that there's going to be more hawkish tones and rate hikes are on the way, I don't think we're there just yet. We're not in the camp of rate cuts by any means, but we're not in the camp of rate hikes either.
I mean, listen, I've been saying over the past couple of days, good riddance to the dot plot. Let's get rid of the dot plot, because the dots can change and do change. And if there's anything that the last few years have taught us, it's that we do not have, nor does the Fed have, good visibility on what's going to happen with the economy or what's going to happen with inflation. So let's stop pretending and just get rid of the thing and eliminate the exercise. What was missing, however, from Warsh, if he doesn't want to give forward guidance, fine. But there's not even a framework. Like the market, what I've seen this morning in a lot of commentary is give us something, man. Give us, how are you thinking about this? And he's basically saying, I will give you that after all these task forces meet. So the market is going to have to wait a little bit longer. And so my thought was kind of maybe it's time for the market to sort of break up with the Fed, right? which seems to kind of be what he wants. He wants the market to pay attention to the data, not to how he thinks how the market thinks the Fed is.
Which is what he said.
Which is basically
he said that. So maybe we should take his advice. Maybe we need to stop paying so much attention to the Fed. And I would argue as well, sorry, I'm getting on the soapbox here. I would argue as well that the Fed is less important for the U.S. economy right now, that a lot of portions of the U.S. economy are less rate sensitive, and therefore we need to stop weighting it as heavily as we do.
Well, on the less rate sensitive, for sure. I mean, this economy is strong. If you took even a look at the initial jobless claims, those came in positive as well. So this is a strong economy. The labor market is strong, and the interest rates, holding them steady, haven't done much. I mean, you still have this enormous AI capex spending, and that's what's driving this economy. So to your point, even if they were to do something with rates, how much influence will it really have on the overall economy?
Right. Not that the Fed isn't important. They are. Their dual mandate from Congress to promote full employment and price stability are very important. But where we've come in the last 6 years in the effort to provide more transparency, I think has created more confusion. There's so much rhetoric out there in between meetings from different Fed governors, often contradicting each other, that it leaves investors and portfolio managers like myself saying,
but
I don't know.
But that's not going to go away, right? In fact, I've seen people and talked to people yesterday who posited that that's going to be even more acute. If the chair is stepping back from providing that, then you have that vacuum filled by all of that Fed speak.
I think he's going to pull back the amount of communication amongst the other Fed governors.
Can he do that, though?
Why can't he?
Well, look at yesterday.
Because they're independent. They can go out and talk if they want to talk, can't they? Does he have the... I don't know if he has the jurisdiction to tell them not to talk.
Maybe the task forces will agree with this recommendation and pull that back.
I'm actually on your camp. I think that there's more of a consolidation of power here. If you took a look even at the commentary, the small commentary yesterday, he kind of spoke for the team. I mean, he did talk about that there were some factions that wanted something or the other, but he really talked about we had a good fight, a family fight, et cetera. But he really seemed to have this cohesive, like, I'm talking for the entire team here. That was, I believe that you're onto something. I'm not sure that we're going to see that much commentary from descendants.
I mean, the other thing I would say when you talk about his tone and his family, like, he was a little overly jokey for my taste, I have to admit. Like, you know, even as I say, like, I'm talking out of both sides of my mouth here, even as I say that the Fed is less influential in the U.S. economy than it used to be, it's a really important job. And here he is, like, you know, he's kind of like, I'm going to fix everything. I've got all the task forces. Oh, I'm going to crack jokes every answer I give. Well, I don't know.
I thought his tone was more measured. I mean, it was a little bit loosey-goosey at times. I'll give you that point. But a lot of people thought he was coming into this chairmanship role is going to be immediate dove. We're going to see rate cuts. He's going to kowtow to the administration.
Right, we didn't get that.
And if anything, we didn't get that.
No, we did not get that.
In fact, what he really focused on is changing the manner in which the Fed accumulates data to make very important decisions.
Right,
and that's what we've been all asking for.
People have been calling for years.
Yes, how he does that, I don't know. Maybe the task forces will figure it out. If it's that easy, why haven't they done it already?
Why doesn't every economist know exactly what's going to happen if it's so easy to get all this predictive power?
Correct.
Yes.
And to your point, maybe we shouldn't be relying upon the Fed to guide our decisions in that regard. But the Fed still controls short-term interest rates. They still control the size of their balance sheet. And those are two very important factors. So I'm not going to ignore them by any means, but I am encouraged by what may come out of this new Fed. But we'll see.
And perhaps his tone was because he really was not going to reveal much. I mean, he really held his cards close to his vest or chest or however that saying is. But it really was maybe those jokey points were because he really was bringing it back to the task force that I'm creating and that
trying
messaging.
not to say much.
Right.
So in the absence of saying that, he kind of like bantered with the people in the room. All right, well, moving on to our next item, because this is an important one and illustrates part of the challenge in his job, and it has to do with prices. So Apple prices, iPhone prices are going up, gasoline prices are coming down, right? So gasoline prices below $4 a gallon now for the first time since near the beginning of the Iran war, although they were below $3 even before that conflict began. So that, yes, thank you, we will take that, gasoline prices going lower. On the flip side, Tim Cook telling the Wall Street Journal that we're going to see some more expensive iPhones. He didn't say how expensive they're going to be, but this illustrates the problem with thinking about AI just as a disinflationary force because it's going to boost productivity. Because right now, it's an inflationary force. It's driving up memory chip prices. and causing companies like Apple to raise their prices.
Yeah, and it's going to continue as well if you keep bringing more manufacturing to the U.S. To the point of Intel and Apple perhaps working together to make chips here. Look, this is I believe that this whole inflation thing, yes, on gasoline prices, great, but there are many other parts of the economy where you see inflation. I mean, even services. You try and get a handyman to do something for you, and it will cost you. You try to fix anything in your house, it will cost you.
I'm sensing some sensitivity here, Ina.
Yes.
This is something you recently tried to do.
Yeah, yes, and these prices are not coming down. When are they coming down? They're not. And so when you take a look at the iPhone, yeah, an iPhone costing $2,000, $3,000 someday, you can pretty much see that. I'm not sure that you're going to get an iPhone that's at 800 or 600 again.
Yeah, and I think the Fed is in agreement with exactly what you're saying, because they raised their forecast for core PC yesterday to 3.3%, even though they believe it's going to come down to 2.5% next year and get closer to their 2% target by 2028. So they see more inflationary pressures for the balance of this year. That's why I think we're kind of stuck between labor market is relatively strong, the economy continues to grow, inflation is rising, we can't hike rates, but we can't lower rates either, so we're just going to sit and do nothing, let the task force figure out how to get better data.
So do you think they're going to hike this year?
I do not.
I don't think they're going to hike either.
I don't think they're going to do anything
People
this
look at me
year.
like I'm crazy when I say I don't think they're going to
Goldman
hike.
Sachs doesn't think they're going to hike either. They're saying that even though there's an expectation, they're thinking that next year, they're actually looking at some cuts perhaps next year. So
The only caveat to that is, let's say this memorandum of understanding unwinds, and over the next 60 days now, the military conflict re-escalates, and the strait closes again, and oil prices shoot back up over 100. Now we're in a period of very sustained high oil and gas prices. The Fed can't just stand by and sit and wait for that.
Yeah, I mean, historically, they've looked through these sorts of things, right?
Thinking it's going to be, I hate to say it, transitory.
Yeah, everybody drink at home, right? Yeah, I mean, and it's tricky that whole transitory thing didn't work out that well. And to Inez's point, prices just keep going up for services and other items. So I don't know where that confidence comes from that the prices are going to come down, or that the rate of increase is going to come down.
Well, they can point to, look, oil prices are lower, so this means that it is going to translate into lower food costs and lower transportation costs.
Hope it does.
So all of that, fine, that's fine, but there are other parts of the economy. My point earlier was there are other parts of your daily living that the consumer is feeling stretched on.
Yes.
Yeah, most definitely. And I don't think we see, even though Kevin Warsh wants to anticipate it, we don't see yet the disinflationary effect of AI and that productivity boost.
And that may not come for some time.
Right.
You think about the billions of dollars in CapEx spending that's taking place right now. It's really build out the infrastructure that's creating jobs, but it hasn't translated into improved productivity or improved profit margin with the companies that are spending all this money right now. So it's not disinflationary right now. If anything, it's inflationary right now. But over time, you'd have to imagine it's going to be disinflationary.
What's so interesting to me is it is inflationary right now, but not with wages.
Yeah.
Right? Because inflation growth is higher than wage growth right now. So it's not, I mean, I assume it's inflationary with the wages that are directly affected, but not.
You look at the wages of some of these AI engineers, though, staggering.
Yeah.
So I think it is disparate across the economy.
Yeah, and even if you use AI, I mean, I was using Claude the other day. I maxed out on it. Now I have to pay some more, and I'm paying it per month.
Hang on. Are you using Opus? Or are you using the lower model?
Oh, maybe I'm using the lower model. I don't know. I'm paying $29 a month for it.
What I'm saying is, you should be if you can get away with you don't want to max out the strength of the model. So don't use Opus, which I think is the fastest one, if you're not doing like super complex stuff. It'll last longer if you're using them. That's my tip.
That's a great pro tip. Thank you.
Julie's tip of the day.
My point being is that at this point we appear to be subsidized in the cost of all of this, right? And so my point is that are you going to see even higher prices for that?
Yeah.
I mean, going forward. So because right now it appears to be we're trying to get as many people on this as possible. So that
we
to
all
me
get
is
addicted.
Yes, exactly. But that's going to be inflationary.
Yeah, it feels like it.
I don't want to use a segue here if you're going to go into Apple and tell
Let's
next.
do it.
But yeah,
Okay. Steal my segue. Do it.
Awesome.
Do it.
But you think about that strategic partnership there to build chips and do it here onshore in the U.S. You think about what NVIDIA did.
Okay, so let's back up what we're talking about here. So Trump this morning posting on Truth Social and talking about that Intel has had agreements with various companies to manufacture chips, and now he's saying they have some sort of agreement with Apple. We don't have details on it.
We don't have details yet.
And I don't think we have confirmation from the companies themselves as of yet. So that's the caution. But Intel shareholders aren't waiting. They're bidding up the stock by 8%.
And if it's accurate, they should be.
Yeah.
But I also think beyond the reaches of the U.S. government, you think about what took place between NVIDIA and Taiwan Semiconductor. NVIDIA, the largest seller of chips in the world, doesn't make their own chips. Taiwan Semiconductor does. But NVIDIA was smart because they partnered with Taiwan Semiconductor to build the capacity here in the U.S. in Phoenix, Arizona, to design their own chips and manufacture their own chips here in the U.S. That created an abundance of new jobs in the United States, and it benefited the surrounding community in Phoenix, Arizona. And that's just one of 3 plants they're looking to build here. So there is an added component to actually increasing the labor force when everyone's so focused on AI taking away from the labor force.
Yeah,
but is that sustainable?
Well, and that's something Jeff Bezos said at a conference yesterday, too. He thinks AI is going to increase the workforce, not decrease it.
I heard that.
In fact, Miles Udland, I mean, I won't say he was smarter than Jeff Bezos, but this is something he talked about frequently in our conversations. He would say, if I was a corporate leader, I would be leaning against that tide and saying, no, we're going to be hiring because AI will create more demand and we're going to need more people to, we don't know how necessarily yet, but you're going to need more people to meet that demand. But the Intel Apple thing is interesting to me as well, because this theme of like these older companies that keep catching the AI wave is really interesting.
It's the legacy plays that I've been talking about as well. That yes, these legacy companies that are part of the infrastructure play. And with Apple, I think it's very interesting because more and more of AI is going to be done locally. So Apple right now, it hasn't been the big talk about town with respect to the AI trade, but increasingly it will be if you get these chips to be even more, if you get more of the AI inferencing to happen locally on your phone. So in the future, this is going to be a huge sort of tailwind for Apple as well and the products that they can build. But to your legacy play, yes, you've had Western Digital this week that's been at all-time highs. You've had Cisco that's been one of the players, Intel. So all of these sort of hardware plays that you need this in order to keep the AI trade going.
Yeah, and Apple certainly needs a tailwind right now as they've been one of the laggards within the overall Mag 7. Don't get me started on my Air 7 comparison to Mag 7, although I'm happy to go there if you need me to. But I also think another legacy play, I mean, what's the next realm in the AI revolution? We're not there yet. Quantum computing.
Yes.
And that brings in Big Blue, IBM. Who would have thought that IBM would be a leader in quantum computing? They actually are.
Well, they've been doing it for
a long time. So all of a sudden now these thematic trends that are taking place across our economy are bringing out some of the companies that have been experienced, that have solid balance sheets and have the staying power to withstand the length of this AI revolution, which I still contend is only in its very early innings, if not batting practice, because we still need to build out the infrastructure.
Yeah, I mean, quantum, to be clear, quantum, like, we're still waiting for that. It's even earlier stage than the AI trade is. And a lot of those companies, IBM is the exception, of course, rather than the rule. A lot of these quantum companies don't make any money yet.
IONQ,
I shouldn't say a lot of them. I don't think any of them make any money yet, the standalone quantum companies, because it's more in the sort of research experimental phase in most of those cases. But I am wondering, like, as the AI trade keeps rolling on, and we keep sort of discovering new pockets. This is a theme I keep talking about. Like, is there any stone left unturned? Is there any part that we haven't realized yet?
And just when they pop up, you think, what's the next one?
Right.
But to your point, these thematic plays, thematic ETFs, I mean, Jared Blickery had written something on this as well, that you've seen accelerating flows into these ETFs, similar to 2020. And that would be space, that would be quantum, that would be nuclear. So it's really a story. Now, in the 2020s, it was about apps and tech. This is about rockets, reactors, everything to do with with these sort of industrial plays as well, if you will, and that next phase of the AI trade.
All right, we got to save a little time at the end here.
Yeah.
Go Knicks!
Yay!
Everybody.
Woo-hoo.
So I was chatting with Josh Schaefer earlier in the week, who is a Boston sports fan.
Oh, I'm
and he
so
was
sorry.
And he was like, I'm very happy about the Knicks, but like everybody in New York thinks that the whole country is behind you and that like the Knicks are the only team. And I'm like, hell yeah, we do. I'm like, that's the classic New York City chauvinism, that we're the best city in the world. And listen, anybody who watches this show for any length of time knows I'm not a big sports fan. But like, I'm really excited that the Knicks won. It's a great thing for the city. It's a great thing for the people of New York. And there's a big ticker tape parade today that is set to begin, in about 40 minutes. Everybody who commuted in today was affected by this. We all saw the Knicks fans, or I know you drove in. There was definitely some Knicks traffic. They're going to have 10,000 police officers on the ground today. I saw by 7:30 a.m. the designated area in downtown New York was already full. Like the people had already streamed in. So it's going to be crazy today in New York City.
Yeah, and to Josh's comment, I mean, bah humbug, come on. This is, it's been more than 50 years since they've won. So this is a moment for New York. Just let New York have its moment. To your point about this parade, I saw that there were some sitters for places.
Yes, you could pay people to hold your place in line.
That's wild. Or you could get a hotel. I mean, imagine if you're in one of the office buildings up there as well.
Yep,
you're
they're
watching
definitely
this parade. But no, this is a moment. This is a moment for New York. And one other thing is that Sazi had compared before back in 1999 when they went to the playoffs, but they didn't make the championship. And then I saw the dot-com bubble bust. Now maybe this is a good omen that you won't see any bubble burst.
And we're showing all the people there who are waiting for the parade to begin. And it's steamy today as well, we should mention. So hopefully everybody there brought their allowed plastic water bottle. They're not allowed to bring glass bottles, of course.
So I had
filled with things other than water. Who knows?
I had to dig deep into my closet to find something of Knicks colors.
Oh,
That's the best I could do
nice.
with my orange and blue tie.
No, I think you did great. You definitely get points for that.
What a great moment for the city and Knicks fans. Over 50 years in waiting. I'm a lifelong Jets fan as well. Woe is me. Can you imagine what this city would do if the Jets ever even made it to the playoffs, much less won the Super Bowl? Hopefully that's coming too. But it's going to be a fun day in the city.
Yeah, and it's also, obviously there is also a huge economic impact. I was watching an interview that the New York City Economic Development Corporation chief, CFO, gave to Bloomberg, and she talked about that $382 million was the economic impact of home games, and it would average about $90 million per finals game, because not only do you have obviously the ticket sales in the Garden, but you have all of the people watching it, spending money in bars, spending money on snacks, et cetera. And so this is a big boon for the city. It's been a big boon for Madison Square Garden stock. I don't know if Jim Dolan has redeemed himself in the eyes of New Yorkers, but it's a complicated relationship that they have with the Knicks owner. But so there's just a lot of financial and economic stories to be told with this Knicks team as well.
And I just hope that it's a safe and fun celebration, and we don't see any damage or any violence where we're going to have to use some of those funds to repair things.
Yeah, the cleanup though afterwards, after these after these parades is serious.
Talk about economic. I mean, the amount of cleanup that you need to do there as well. You're going to have also workers that are doing all of that cleanup, et cetera.
Oh yeah, it's like New Year's Eve.
Yeah, and fun fact, it's not really a ticker tape parade anymore. The ticker tape was
We have ticker tape?
No, we don't have ticker tape anymore, so there's not, it can't be a ticker. That was like the actual machine that would spit out the prices. As we all know, being familiar with the ticker tape, we're not, none of us were here when the ticker, but now they actually buy recycled paper and shred it into confetti, and then that's the confetti.
It's a confetti parade.
It's a confetti parade, but ticker tape has a certain gravitas, doesn't it, that meets the moment of what a big moment this is.
Yeah, fans have been waiting for this for decades, and people talk about their dads and their granddads. I mean, they talk about really it's a family legacy kind of thing as well, the Knicks.
Go New York, go.
All right, thanks so much, guys. Great to have you both here. And that does it for Morning Brief. Opening bid is next. Brian Sazzi's got you.
despite all your gripes, you, the investor, had it pretty damn good under now former Fed Chairman Jerome Powell. He over-communicated the Fed's next moves. That allowed you to be better prepared with your portfolio. He popped up in intra-meeting interviews. Loved seeing Jerome do that. That also allowed you to be better prepared with your portfolio. And most importantly, he didn't do anything really with interest rates for some time. If anything, he leaned on the side of cutting rates, even in the face of the recent bout of Iran war-fueled inflation. But as new Fed Chair Kevin Warsh reminded the world on Wednesday afternoon, he will be a different beast for markets and executives throughout corporate America. Warsh will say less, review all old Fed practices via task forces, and in the near term, defend independence from the Trump White House that backed him. All of this can mean an interest rate hike before year-end to beat back inflation once and for all. You had it good under Powell, but now the dynamic has changed, maybe for years. Big opening bid roundtable for today with hot takes on the Fed. Adam Turnquist, LPL Financial Chief Technical Strategist, alongside Yahoo Finance's Brooke DePalma, Jared Blickery, and Jennifer Scharnberger. Power packed. I mean, I can see, look at all these boxes on the screen. I can't even contain myself. Jared, I want to start with you real quick. Yeah. We saw the market sell off on yesterday's Fed news. Any damage done technically?
I don't know that there was damage done, but it was definitely risk off. I think the hawkishness of some of the statement, how it was pared down, kind of caught investors off guard. If we could go to the Wi-Fi Interactive real quickly, I'll just chart the two-day price action and show you how things were developing yesterday. Now, in terms of breadth, and by the way, we're looking at the Dow 2-day here, and I'll just highlight, we took a dip down on the 2 p.m. report. I haven't seen that much movement off of the actual the report drop in quite a long time. So that would be the FOMC statement. And then you can see as Warsh began talking and through the end of the day, it was just kind of to the down and to the right there. In terms of breadth, and I'm going to show you the S&P 500 here, and you can see it's leapt back up today. So we're almost to where we were trading just a couple days ago at the close. But in terms of breadth, we had 355 S&P 500 issues trading to the downside versus 145 to the upside. That was the worst this year. So something to kind of keep in mind today as we're looking at the tape.
Jen, this wasn't your first rodeo covering a Fed chair transition. What are some of your takeaways from this?
Listen, Brian, for all the talk that Warsh was a dove, a leopard doesn't change his spots. And Warsh was the same Warsh that we've seen in transcripts of FOMC meetings and speeches that he gave when he was a Fed governor, focused on price stability, which earned him credibility. And the committee very clearly laid out that they don't see inflation returning to their 2% goal until 2028. Inflation has been running above their 2% target for more than 5 years. That would be 8 years until we see inflation return to 2%. And Warsh very clearly said, we have work to do when it comes to price stability. He was almost single mandate focused. And so you're seeing bets for rate hikes rise for this fall. September could be in play, October perhaps more so. And I think this means that inflation reports are going to take on that much more attention for markets.
Hey, look at those dots on the screen enough, guys. I think it's SpaceX's stock symbol. I mean, that's what those dots do to you. Jen, real quick, what took me not by surprise, it was just very interesting to hear Warsh tell the American public, look, we can't bring down your chicken prices.
Listen, that was interesting as well. I think that, the fact that Warsh is not sticking to forward guidance, but did speak for the rest of the committee was interesting to me because he decided not to participate in the dot plot or the SEP, but the rest of the 18 members of the committee did. And so while Warsh is not going to engage in forward guidance and speak less frequently, I wonder if we will be able to look to the rest of the committee for more insight into what they will do and how frequently they will speak. And I asked New York Fed President John Williams before the blackout period if he intends to change the frequency with which he communicates, and he said no. So it's going to be interesting to see if we see any dichotomy here between the regional Fed heads, the rest of the Federal Reserve Board, and Kevin Warsh.
Oh, I love me some Fed member tension. Love it, Jen. I just crave this stuff. Brooke, what did you see in the bond markets off of this?
Well, the bond market was definitely spooked. Like Jen had noted, heading into this meeting, we expected that maybe, perhaps, Kevin Warsh would go with a more dovish tone. But coming in, or a dovish tone, largely because of the fact that he truly did believe, as he mentioned, about AI boosting productivity and so on. But instead, because he was more hawkish, we did see a reaction, as you can see on your screen, within the bond market. When you take a look particularly at the 2-year Treasury yields, we saw some of the biggest reactions that we've seen since Liberation Day of last year. And then on top of that, too, in reaction to a Fed meeting, we haven't seen that sort of reaction since, don't get too scared here, but since 2008. And so definitely some reaction there when you think about the short-term impact of the Federal Reserve's policy. We also did get some movement on the 10-year T-note as well. That rose more than 7 basis points. But I think that really the big question here is how soon could we see that rate hike? And now we sort of have these different takes about just how soon that could be, whether it's July, September, October, or wait out until December for this war to really come to a close and for that ripple effect to really bleed through fully.
Brooke, I am scared now, and I was already scared coming to the show because I have to go to Penn Station right in the middle of this Knicks parade. I'm already scared about getting, look, I'm getting trampled. Like, I'm really concerned about it. Adam, speaking of getting trampled.
Don't be scared. Don't be scared.
No, I'm a little scared. Adam, speaking of getting trampled, that's what happened to the markets yesterday after this Warsh meeting. How much did he disrupt the bullish narrative in the markets leading up to this Fed event?
On a short-term basis, there was a little damage. The S&P 500 failed at its 20-day moving average, right around 74.88. So keep an eye on that level this morning with futures higher. But long-term, the market's already in tune with this shift from rate cuts to rate hikes. And we've seen that play out in 2-year yields really since March. They reversed a downtrend, broke out above the 200-day and the Fed funds target rate. And that was really the first signal that we should be expecting a conversation about rate hikes versus rate cuts. And of course, we're getting confirmation of that with the recent dot plot changes. And I think that was the real fireworks yesterday when we went from no penciled in rate hikes in the March summary of economic projections to now half the members actually forecasting at least one. I think there were 6 members that priced in 2 rate hikes this year. So a much different narrative. I'd say the market absorbed it pretty well. Still in a bull market, very much so, but I do think there could be some turbulence here this summer, especially as we work through this 60-day peace deal with Iran.
Adam, how much, investors under Powell, and I'll even go back to Janet Yellen when she was running the Fed ship, have been conditioned to buy the dip. Is that still likely to stay in play?
I think so, and until it's broken, and that's been the scenario. Retail was a little bit slow getting into this latest dip on the March lows, but they're very much back in action in buying single stocks. They're chasing IPOs like SpaceX. So animal spirits are alive and well, and that buy the dip Freudian response certainly seems to be in play right now.
Jared, what a lot of things, I should say several things bothered me from this Warsh first Fed press conference. But out of everything, I came away thinking, Jared, we are looking at a potential higher cost of capital. And this comes at a time where the major hyperscalers, members of the Yahoo Finance Fab 10 index, as I'm internally calling in my head, Anthropic, OpenAI, they're raising a ton of debt, Jared. And they have expected easy money, or they've feasted off easy money for the past year. That dynamic could change, even for SpaceX, and that could be a big headwind to a lot of these tech companies.
Yeah, a few things to note there. And I would look at longer term interest rates, and I'll show you a year-to-date chart of the 10-year on the Wi-Fi Interactive. And actually, let me bump this up to a 30-year, because this is really the one where the levels, I think, matter the most. So 5% is kind of a big line in the sand, and you can see we broke above that in mid-May, and I don't think it's coincidence that we saw some problems with stocks there. If I show you a 3-year chart, we've been above 5% a few times. I'm going to circle all of these. All of these were stumbling blocks for stocks, and it was short-lived because we came back down below that 5% level pretty quickly. And usually in bonds, it's not about the levels, it's about the speed of the move. But my concern is that if the Fed loses control of the long end of the yield curve, which is something they're not directly trying to control right now, that does raise the cost of capital, and it also raises the cost of capital for the United States government. So above 5.1, 5.2%, you really have problems. But I would say right now we've been coming down recently. We're at 4.88%, and I'm not going to give the all clear here, but it looks like that reaction yesterday to Fed Chair Warsh, the new chair, was definitely to the downside in yields by the end of the day. So I think that's actually a good thing.
Adam, are you still like the Mag 7? Is this trade dead in the water?
I wouldn't say dead in the water, but certainly subject to some further selling pressure. When you look at just how overbought the tech sector is broadly, we were at the highest premium to the 200-day moving average since March of 2000, not long ago. And we violated this parabolic uptrend. I'm leery of buying the first dip after a break of a parabolic uptrend. You tend to get further drawdowns. The rule of thumb among technicians is usually you retrace about 50% of that parabolic move, which would suggest there's some additional downside. You look at the momentum indicators as well, diverging a little bit with price action, suggesting some of the buyer enthusiasm is fading a little bit. Now, these are near-term signals, not making the call that the tech sector or the Meg 7 trade is over, but I do think subject to some further drawdowns here.
Small right turn here. New episode of my podcast dropped with Coinbase co-founder and CEO Brian Armstrong. He said earlier in the week he thinks Bitcoin has bottomed. Here's what he told me.
If you just look at the past trends in Bitcoin, I think we bottomed at 60K or so. But like a lot of things could drive growth of Bitcoin here. I think market structure, legislation passing. I think some of these AI companies going public because they've been soaking up a lot of the risk capital. So once these companies get public and the unlocks happen, like I think you'll start to see capital move back around.
And Jen, I'm sure you've seen the back and forth between JP Morgan CEO Jamie Dimon and Brian Armstrong on all things Clarity Act. Where does that legislation even stand at this point?
To see some arm wrestling on that. I think that the banking lobby is hoping that while they couldn't get through to the Senate Banking Committee to get it in favor for the banks, they're going to try to target key senators before a floor vote. So I think we do have some time before we see this legislation sorted through and officially passed. But I do want to go back to what you were saying very briefly about tech companies and rising rates. I think we need to put into perspective that, yes, we have an inflation problem right now, but if the deal with Iran holds and headline inflation is in the process of peaking right now and is going to start to come down later this year, I wonder if you even see the Fed hike rates at all. If they do hike it, later this year, I think we're talking about maybe 1 or 2 hikes. We're not talking about what we saw a couple years back, which was the most aggressive rate hiking cycle since the 1980s. So these are stalwart tech companies that are able to get good borrowing terms. And let's also remember that the big, beautiful bill allows them to expense immediately. So that help offsets some of these higher borrowing costs. I wonder if this is going to be a real problem.
Hey, thanks for talking me off a ledge, Jen. I do hope to own a home sometime within the next 25 years, so I appreciate that perspective and all the perspective on this big OB roundtable. Thanks all. All right, straight ahead, big layoffs this week at Robinhood is a reminder as to what's coming at the hands of AI. I am live with one of the people that was way early to warn about AI-related job loss. That is Andrew Yang. That's next. Andrew Yang was ahead of every politician in America on this issue. He ran for president in 2020, warning that AI and automation were going to hollow out the American workforce, and Washington laughed at him. Nobody is laughing now. Tech companies have already cut 100,000 jobs this year alone, and Goldman Sachs puts the current pace of AI-driven job displacement, roughly 16,000 American positions lost every single month. That number is only going to accelerate as agentic AI moves from the data center into the office. Entrepreneur and former presidential candidate Andrew Yang is here with me at Yahoo Finance HQ. It's good to see you. I follow you on X. It's good to see you in person finally.
Yes, I'm real.
Yes.
I'm still.
Yeah, like he's real. Like he's like a real guy.
Yes.
Look, I remember it feels like yesterday when you warned about AI. At the time, it was 2020. Nobody even knew what the hell AI was. What we're seeing right now in terms of job loss, are we still at the tip of the iceberg, or like we are in the middle of the iceberg?
Oh yeah, we're just in the first or second inning, and a public company CEO reached out to me, bought me breakfast, and said, "I'm going to fire 30% of my workforce, and my revenue is going to go up 200%. And I'm going to get a raise. What do we do?" And so these are the very early days. Look, was there some muddying of the water in terms of the tech layoffs? Like, did they overhire, and then are they using AI as something of a justification or rationale? Yes, but the AI buzzsaw is real.
What if a company replaces or releases or fires, however you want to say it, 10,000 plus workers, which is what we have been seeing? What do they owe society?
So this is the harsh truth, is that the purpose of a corporation is not to employ lots of people. And it used to be a generation ago, if I was a CEO and said, hey, I employ a lot of people, that's a badge of honor.
Yeah.
Now it means you're a schmuck. You're the curve,
Yes.
and like, what are you doing wrong?
Yes.
And so the purpose of the corporation is to deliver its product or service as cost efficiently as possible. And I'm not like a cult of shareholder value maximization guy, but it is certainly not the CEO's responsibility to hire and employ a lot of people. And so this is why I ran for president. It's the government's responsibility to help manage this transition, but our government, in my opinion, is asleep at the switch.
Where does this all leave this concept of universal basic income?
It's becoming increasingly mainstream and common. When I ran for president in 2020, shame I didn't I didn't prevail, but the approval
I thought you were going to.
Oh, thank you.
No, really, no
Yeah.
BS, seriously.
So universal basic income's approval rating at that time was in the 30s. Now it's in the mid to high 60s because people get it. And they saw that government can actually send out stimulus checks quickly and broadly. And it works, it helps.
What should the American worker do at this point with this AI tidal wave coming at them?
They should try and become conversant and expert in these tools. Mark Cuban makes the case that a bunch of small and medium-sized businesses are going to need folks to help implement and deploy. I agree with that. But it's to know that your job's days might be numbered if there are a bunch of you in an office or cubicle. And a lot of folks I know who are in the industry say, I can tell they're training the AI to replace me. I'm training my own replacement.
Is it the incentive, look, CEOs of public companies, they have to maximize shareholder value. Isn't there's more incentive for them to now fire as many people as possible?
Yeah, and they're going to lose their own job if they don't do so, and they all know it. I mean, you see multiple CEOs stepping aside, and then on the way out, they're like, hey, one of the reasons I'm doing this is because of AI, and I'm not sure I fully understand it, and parentheses, I didn't want to...
They don't want to be the face of this crap.
I didn't want to chop, 30% of my workforce. It's miserable, so I'm going to step aside and let the next person do it. And the public markets reward you as soon as you make the announcements. Like, we cut 10,000 workers, and then our stock pops.
Are you running again in 2028?
I get asked every day, Brian, and I will say my case has aged very well.
You got a lot. You have a lot of W's on the board, man.
Oh, well, thank you. I'm still very much here and willing to serve, and so we'll have to see what 2028 holds.
What would President Andrew Yang do? 2028, AI is even more powerful. Would you tax AI?
Yes, and that's not just me saying it. That's Dario Amodei saying token tax. It's Sam Altman saying National Wealth Fund. It makes zero sense that you'd have AI, which compares itself to electricity, and then not tax it and not regulate it. Can you imagine if the power grid was unregulated and untaxed? It'd be insane. So that's just, again, an example of our government not being on the curve.
So don't tax employees, per se. We got to tax AI companies.
Yes, I run a company, Noble Mobile, and we are discouraged from hiring because we have to pay for your health care, we have to pay for your Social Security tax, then you're going to pay like a ton of income tax. There are a number of people like Vinod Khosla and others who are saying we should stop trying to disadvantage hiring and human labor, and I totally agree with that. Right now, if I use the bots, I'd pay zero in taxes, and the AI company pays zero in taxes. And then if I hire you, then I pay a bunch of tax, and so do you.
Seems whack. It was 2019. You actually got an endorsement from Elon Musk. I think we got the tweets. I went and found them, so I'm glad they still exist out there. What do you think about? There it is. What do you think about the increase in his wealth since then? I think at the time he was worth $20 billion. Now he's our first trillionaire.
Yeah, he's creating a lot of value, and he's for universal high income because he thinks that AI and robots are going to create so much growth and do a lot of the work. Elon's not just been ahead of the curve, he's been making the curve happen.
Would you still accept an endorsement from him if you did run it?
Yeah, I would. I mean, shoot. He's for trying to advance society in different ways. Don't agree with him on every single thing, but like, who the heck agrees with someone on everything? Would gladly accept Elon's support.
One, and I suspect you have your take on this, and this news crossed late yesterday. Proposal to tax the wealth of billionaires in California has got enough signatures to appear in the November ballot. Like, what do you think about that?
I think wealth taxes on the state level are a mistake. People are portable, capital is portable, and imagining that they can't move to Austin is dumb. I mean, billionaires have things called planes. They also have accountants and other things. To me, the goal should be to try and get the value from AI, from the bots, but a state level wealth tax isn't the way to go.
It got me thinking, like, what would happen to California? Like, look at you are in tech, you understand this space. Like, what would happen to California if like some of the most innovative CEOs and companies move out of that state?
You're already seeing that happen in Seattle. Some people departed, and California, because they see the writing on the wall with some of this legislation. So unfortunately, California might be able to illustrate what you're describing, not in the hypothetical, but in real life.
Lastly, I know you're a big crypto guy. Crypto has really had its moment. Where do you see the future for crypto?
I'm for localized currencies that can keep value in a community. To me, I will say, one of my issues with crypto has been that the primary use case has been financial speculation, and that's not what attracted me to the space. It was around poverty alleviation and innovation in the way that we use currencies. I'm still a big believer in localized currencies, and even currencies that reward things like health and wellness, arts and creativity, nurturing and caretaking. Like that's the vision that I think crypto should get behind.
Lastly, tell us about this new book. You read this. What do I need to know from it?
Hey Yang, where's my $1,000? Which I've gotten on the streets of New York. The alternate title was Hey, am I racist, or are you Andrew Yang?
But that'll get your attention.
Yeah, maybe I should use that one. But it's fun stories from the trail and hopefully a path forward.
Good to see you. It's been a while. I appreciate you doing this.
I'll be back for sure, Brian.
Yeah, thank you. All right, Date Safe, big episode of my Power Players podcast dropping Monday at 6 a.m. I go one-on-one with the founder of Binance, Changpeng Zhao, better known as CZ in crypto circles. We talked about his time in jail. Very interesting comments there from CZ. The latest crypto winter and how he plans to spend the next decade of his life. You can watch the full episode on Yahoo Finance, YouTube, Roku, and Samsung TV, or listen in on Apple Music, Amazon Music, and Spotify. Julie Hyman has you next on Market Cap.
analysts. I'm Julie Hyman, 30 minutes into the U.S. trading day on what is a holiday-shortened week. Reminder, we are closed for trading tomorrow. But let's take a look at what's going on with the major averages here today. So we had obviously a drop yesterday after Kevin Warsh's first press conference as chair of the Federal Reserve, a press conference in which he didn't give much information, but the market took away a hawkish tilt from the Fed, especially given the summary of economic projections was split between hikes and no change before the end of the year. All of that said, we are recovering today in part on what seems like confirmation of a cessation, if not a permanent halt to hostilities between the U.S. and Iran. So right now we've got the Dow up about 260 points or so, about 0.5%, the S&P up about 0.8%, and the Nasdaq Composite up about 0.9%. We continue to watch bond yields carefully here as we see the 10-year little changed a little bit lower after a move higher yesterday, but still below 4.5% by a pretty good margin, and the 30-year similar story there. It is now at 4.87%. Checking on crude oil futures here, taking a look at WTI in particular, we see that drop there again on the hopes that we will start to see oil flowing in more volume through the Strait of Hormuz and that we will start to see fewer price spikes like we've been seeing as of late. Looking at more detail in what's going on in the stock market here today, energy stocks continue to lose ground. They had been one of the best performers this year, but we've been seeing that chipped away at. And then we see the cyclical groups do well. Tech back in the driver's seat, up by 2.2%. Industrials up by 1.2%. Everything else is sort of in line with the overall market move today. Looking at the Nasdaq in particular, we see some strength in chips. Broadcom up again. Nvidia shares are higher as well. Kind of a mixed picture elsewhere. We talked earlier about Intel rising after President Trump posted on social media that Intel's latest partner will be Apple after it agreed to manufacture chips for other companies like Nvidia. The companies themselves have not talked much about what the details of this would be, but the shares are rising on the president's comment there. I mentioned semiconductors. Wanted to get to that because we are seeing a pretty broad rally within the semiconductors, whether it is as a result of Intel or just a result of more sort of risk-on sentiment benefiting what has been a very hot sector. Probably more in the latter camp than in the former. And also wanted to check on, as we have been all week, what's going on with shares of SpaceX. So here's SpaceX today. The stock is off by 6% here. And if you stretch it on out to how it's done since the IPO, obviously you've seen a big lift. The shares first started trading at $150 after pricing at $135, and we've had mostly upward movement over the past few days, although over the past couple of days, a little bit less enthusiasm within the market, but we'll continue to watch that and track the other IPOs as they come to market. Getting back to the Federal Reserve and Kevin Warsh's first meeting yesterday. Warsh, he has a simple request for the market. He basically seems to say, pay attention not to what you think the Fed is going to do as a result of data as it comes out, but just trade off the data itself. Is that easier said than done? Let's find out. Seema Shah is joining us now, Principal Asset Management Chief Global Strategist. Seema, what do you think? I mean, the market has been built this way for quite a while now in this modern era of the Fed, that we get a lot of communication and the market tries to suss out what do they think the Fed is going to do. So now that they're pulling back and Warsh is saying trade on the data, how do you think that's going to work out?
Hi, Julie. Well, as you said, this is, it's a nice idea. It sounds really good. And certainly when Warsh first said it, I thought, yeah, that makes a lot of sense. But actually, you can do a lot of mind twists and flip-flops on this as you start to remember that, look, the market is inevitably, it's forward-facing, it's forward-looking. It's always going to try and game out what the Fed is likely to do and how it's going to respond to the data. I mean, that's the way that the market is built. And actually, if anything, without the forward guidance, understanding of their reaction function, it means that the market is going to be a little bit more volatile to the data as it unfolds, which we already know, as he specifically pointed out yesterday, that some of the data probably needs to be revisited because it is fairly unreliable.
Yeah, it is fairly unreliable. And by the same token, like the economics profession, and I think all of us who follow the markets have sort of grappled with, what the right forecast is over the past several years, because it has been a very noisy time. So going forward, what are you going to be sort of queuing off of? Are there certain reports? Because it seems like the committee is really tilting towards being concerned about inflation. What are you going to be watching most closely?
Yeah, I mean, as you said, I think from what Walsh was saying yesterday, the focus is really on price stability. So that means greater focus on inflation. I mean, there already is. It's not like the market has been dismissing it by any means. But I guess further focus on inflation measures, further focus on inflation expectations. But that doesn't mean that we're going to look away from the labour market, how the jobs data is going. But that's still part of their mandate. And it, of course, it will ultimately lead through to price pressures if you're seeing the labour market heating up. I think what we're facing, though, in the months ahead, specifically, until the end of the year, when hopefully we get some resolution from a couple of the task forces, is there is going to be that additional volatility where markets try and understand what the reaction function is, what is the really important data that the Fed is going to be focusing on. I do think one of the things that he did say yesterday, which is really important, that we do really strongly agree with, is this trying to understand what the impact of productivity and AI is going to be on the economy, on inflation, therefore on how the Fed should respond. That's something which is still very cloudy at this moment. I think all economists are trying to grapple with it. So I think getting a forward-looking perspective from the Fed on that is going to be very, very useful.
Or at least a framework with how they're thinking about it, right? Even if they're not going to give us like forward guidance, some sort of parameters. So ultimately, do you think that the Fed is going to have to raise rates this year?
So we came into the meeting expecting rates to stay on hold throughout 2026 and through 2027 as well. With the resolution, hopefully some kind of resolution with the Iran war, we are hoping that inflation pressures start to subside a little bit during the summer months and beyond, and that inflation expectations should, in that theme, stay quite anchored. So that's the main reason. Now, I have to say, of course, that the probability of hikes have increased after yesterday's meeting. We're still holding on to our expectation for no change, but I have to acknowledge that the chances have increased for at least one or two hikes this year.
And you mentioned, of course, the Iran war as a feed into all of this because of the effect it's had on oil prices, although it has not been the worst case scenario that some oil pundits were pointing to. How do you think about geopolitics at this point, especially after a period where the markets shrugged off a lot of those worst case scenarios?
This is, I think, of course, we've had this real event happen over the last couple of months. But to our minds, actually, geopolitics is something that we almost need to bring into our overall thinking as we look ahead over the next 5-10 years. We see a world where geopolitical conflict is likely to be increasing. And from that perspective, governments around the world are going to be focusing more and more of their spending power on energy security, defense, and trying to really build out their foundations. So I think there's a lot of thematics which come through this. One of the things that we do ultimately expect, though, is that inflation is going to be structurally higher. And so with that in mind, also having an understanding from the Fed how they're going to be responding. At the moment, we're grappling with something which is very difficult to pass through what the Fed's reaction function is. So as you said, getting some kind of framework from the central bank is going to be really key going forward to how we can think and how we can start to model the impact of geopolitical shocks.
So put it all together for me, Seema, sort of strategically, what you do specifically with equities right now. Do you sort of stay in tech? Do you stay the course here? How are you thinking about it?
You definitely stay the course. I mean, ultimately, the main foundation that we have to rest our forecast on is what is going on in the economy. And from that basis, we're still very positive. We see a backdrop which is very constructive, strong labour market, continued resilience in consumer spending, and then, of course, a very significant push on the AI CapEx side. So from that perspective, earnings growth should continue to be positive, and that should firepower earnings and the equity market overall. In terms of where you have to be, well, I think this is a real case for diversification. Of course, we want to be in technology. That is going to be a key driver going forward, and there may well be blips along the way, but ultimately we do think this is a driving force for the economy. But you want to have diversification, because when you have these kind of valuations, the kind of signs of a bit of froth in the market, you need to have offsets to that. So increasingly, we've been looking at China. Actually, it's been a little bit separated from the broader US hyperscaler tech space. And so we think that could outperform if in the event that there is a bit of a pullback on the tech side. And then overall, continuing to focus on cyclicals because of that constructive macro backdrop.
Seema, great to see you. Thank you so much. And as we head to break, as we've been talking about, today the New York Knicks getting a ticker tape parade in downtown Manhattan. You see there the people lined up. People were heading into the city very early this morning in order to get their spot for the parade. So we're excited here at Yahoo Finance. We're excited here in New York. And we're going to be taking a peek at the parade as it goes. We'll be right back. For a lot of investors, building wealth isn't just about their personal success, but about setting up the next generation. That's why my next guest is focused on. That's what she's focused on. Joining me now, Alexandria Hood, Wealth Table Advisory founder, for this week's FA Corner, brought to you by Capital Group. Alexandria, thank you so much for being here. You know, we talk a lot on the show about building wealth, right? About people getting into the market. And I think in many cases there is this assumption that you have wealth to invest to begin with, right? But what about the people who don't, right? What about folks who don't have that large pool of discretionary income that they're able to put in the market? Where do you then begin?
You just begin. And I love that question. I love that question. You do not need to have thousands, hundreds of thousands of millions of dollars to begin investing. You can start wherever it is that you are. It's true if you've ever heard someone say, you only need $20 a week to invest. It's absolutely true because that compounds over the years, especially if you do it into safe investments such as index funds.
And I know you and your business, you're focusing on working class families, middle income families. Do you feel like that the advisory industry has started to clue into that those folks need services too?
Yes, they are finally waking up to it. It is an absolutely undermarketed and underserved community and what I've noticed is people who look like me, whether it's by race, gender, or economic standing, they don't think that they deserve or that they should have a financial advisor. Whereas this is the time where you should have one before you begin to make an excess of money that you aren't used to, so that you have a clear plan of how to grow it and maintain it.
Do people, though, also think that they can't afford it, right? That financial advising is something that they don't want to spend the money on or don't have the money to spend on?
They do think that, and I do believe that the traditional finance industry plays a part in that because, again, low income and single income households are very undermarketed. So because no one is marketing to them and saying, hey, I can help you create a budget where you are right now, they think that they shouldn't have one or they don't need one.
Alexandra, I'm curious to ask you about a couple of things in the news and how they sort of speak to your client base, right? Of course, you're aware of the accounts that President Trump has rolled out, that sort of are seeded accounts from birth that babies will get to hopefully build some income for them over their lifetime. Do you think that's a good thing? Do you think it's a good beginning? And how do you think that could be improved on?
I think it's an opportunity, regardless of where you fall in the political space. It is an amazing opportunity for you to take that $1,000 that is being stated will go into these minors' accounts, and then make sure that you invest with it and you invest in companies and funds that will grow with that minor.
And then the other thing I'm curious about also, at a time when we now have a trillionaire, right, and at a time of big wealth inequality, do you think that the people are sort of inspired by that? These people who are worth incredible amounts of money that are hard to even envision? Or do you think it makes them feel like the system is rigged? And sort of how do they then think about how they can participate?
I'm going to be honest. I could give the politically correct answer here and say that people are most likely inspired. But a lot of the conversations that I've had recently, people feel as if the system is rigged. And in some ways, I can understand why they would think that and why they would think that they aren't allowed to be a player in the game. But the game is being sold right now. The game is being told, I should say. And it's now our job to make sure that we pay attention and we follow suit. Regardless of what you think about this trillionaire status, he is showing us that it's possible.
Indeed. And I'm glad you're out there helping people do that. Alexandria, thank you so much. Really appreciate it.
Thank you.
That was FA Corner, brought to you by Capital Group. Coming up, we'll get a check on some trending tickers and also be talking about agentic shopping. Is it around the corner or far away? We'll talk about it next. Well, AI seems to be rapidly changing some industries. Retail's off to a bit of a slower start. New research from American Express finds that while 78% of consumers believe that AI can have a positive impact on their shopping experience, just 35% would be comfortable having an AI agent complete a purchase for them. So there's a gap between that AI enthusiasm and the trust that people have in those systems. Joining me now on this is Anna Mars, American Express Group President of Global Merchant and Network Services. Anna, it's great to see you. And I think there's a lot of curiosity, right, about this whole new world of agentic shopping. But to the point of your survey, people maybe aren't quite ready for it. Is that the sort of takeaway here?
Well, it's great to see you, Julie. It's great to be here. Those great stats really do show what you could call a trust gap. You know, for agentic shopping to really take off, consumers need to trust they'll get what they intended to. Merchants need to trust that it'll work, you know, both at the purchase point and on the back end. And we need to know that the payments network in between is going to work to reduce fraud and handle the protocols that make this easy. So we believe it's coming, but it's going to move not at the speed of technology, rather at the speed of trust.
And that makes sense. So how do you close that gap? Is it a matter of just sort of time and chipping away at it and more people having more experiences, both on the merchant and consumer side, that are positive, that, you know, things don't go wrong?
Well, I don't think it's that dissimilar to what we saw with the growth of e-commerce 20 years ago or digital wallets more recently. People need to experiment and try it out. We're still in the phase of sort of AI-influenced, human-approved agentic commerce, which means that customers are already using large language models and you know, Claude or ChatGPT to research their shopping purchases. And as you said earlier, they're finding it really useful. You know, it helps people discover in the discovery phase. But what we need to see is that flow through to the whole phase of a commerce experience. So it's already useful for discovery. We're putting in place the protocols, working with many industry participants to make it easy to check out. And then on the merchant side, be able to surface inventory, make their policies, their returns policies, for example, really clear. And then the post-purchase experience. You know, I remember back when e-commerce was first taking off, the question of how returns were handled was a big deal. Now that's very much worked out, and that has to happen in the agentic space too. And critically, the concern for consumers is like, what if I tell the agent to buy me a red dress when it goes on sale and I get a blue dress?
Yes.
What happens then? And that's a space that we've leaned into with something called agent purchase protection, right? Because in this world of e-commerce, you've got human error. It's sure it happens to all of us. But in the world of agentic commerce, you could have agent error, and we want to make sure that our card members know we have their backs in case the agent doesn't do exactly what you instructed it to do.
I'm also curious, Anna, and it's interesting that you talk about the era of e-commerce broadly. Now that we're in this AI world, and we've had this discussion on my show before about Apple specifically, and its pivot to Apple Intelligence, that people don't even necessarily need to understand that it's AI or that it needs to be branded AI. They just need something that is useful to them, right? And so I'm curious, as you think about agentic, what is the proof point? What is the use case? Do you think it's going to be the tipping point of when people see this agentic shopping as something that is really useful in their lives?
It always happens earliest in select industries, as you say, where the use case is really clear. And one that we're talking about that others talk about is travel, right? Because it's a complicated purchase journey. You have to do a lot of research. It's a space where prices change, so you know that hotel price might go up or down. There's a point where you can't just be online checking the prices all the time. You'd really enjoy delegating that to an agent that can be out there searching for you. And so we'll see it grow in certain industries earlier. I think travel is a great example. Complex purchases, maybe commodity purchases in some cases might be easier because you're not as worried about getting the exact right thing. And what we see now is a number of industry participants working to make that happen. And so it's a phase where we're seeing a lot of different protocols emerge, whether it's Google or Cloudflare or Coinbase. They're protocols that you participate in to get this all lined up to begin to see it scale. Consumer behavior always takes a little bit of time to change. And so it'll be those early use cases and the proof and the value both to consumer and to merchant, where the value can really be there to begin to see it scale. And it's starting. It'll happen maybe faster than we think, because there are some really clear examples of how it can make a consumer's life a lot easier.
And Anna, I'm curious, you mentioned a number of constituents and service providers there, including American Express. How are the merchants feeling about all of this? How, the actual retailers themselves, or, clothing manufacturers or what have you, the folks who are selling this stuff, are they coming to you, or is it more like you and that cohort you talked about saying, we have these services, do you want them? Or is it the retailer saying, we'd really like these services? Or how is that going?
Yeah. Well, when I talk to businesses all around the world, one thing that all businesses have in common is wanting to grow their business. And so that's the proof for merchants, right? Will it help me grow my business? And a clear place where it could or it will is, let's take the abandoned shopping cart as an example. So today, most e-commerce journeys end with an abandoned shopping cart. So when you get to checkout, there are other terms that you didn't understand, like how long it would take to be delivered, or additional charges, or you just got distracted and did something else. And dealing with that abandoned shopping cart, that's a space where agentic commerce could make a big difference, because by the time the customer gets there, the AI has already done the research, already understands the terms of sale, final sale, and return. And so the purchase is much more likely to be completed. It could also result in higher authorization rates. Like, there are times when the transaction fails. Maybe you got your card changed and it wasn't updated in the platform, as an example of why an authorization doesn't happen. So for merchants, they're interested, of course, in growing their business. And as we can show them use cases where it really can help them deal with continued friction in payments, that's what they're looking for. And I'm confident it's coming.
And Anna, we'll keep definitely talking as the process goes on and see how fast it progresses. Great to see you. Thank you.
Hope you try it out, Julie. There's a lot of good things that we can be buying more easily with our agents in the future.
I will at some point, I'm sure. Thank you. Thanks a lot.
All right. Great to talk to you.
You too. Well, Semaphore reported that Fox was not the only media giant interested in buying Roku. Netflix was eyeing the streaming platform, as well as Lionsgate, as potential acquisition targets after losing out on the Warner Brothers Discovery deal. Market domination anchor Josh Lipton sat down with the reporter behind that news.
First thing I want to get into, the fact that Netflix even looked at Roku is fascinating.
Yeah.
Just walk the audience through that. Like, why would they be interested in that asset strategically?
Absolutely. If you think about where Roku sits, as you very well know, it is a platform that every single major streamer relies upon. It's in 100 million homes, right, at least. So it gives anyone who owns that asset a tremendous look into viewership data, into how people are consuming content, what content they like, what content they don't like. For a strategic like Netflix, or we don't know this, but I'm just naming names here, the logical buyers, a Comcast or a Disney, ultimately a Fox. It allows them to lever up and tailor their data collection, their ability to serve content, their ability to get in front of consumers, which, as you now know, is the name of the game. Gone are the days where Netflix was the only player. That hasn't been the case for a decade plus. So that is what it was driving their initial, and I should say it's initial, interest in Roku. Obviously they bowed out. That asset went to Fox, but it does, as you pointed out, signal something. They are, for the first time ever, open to M&A, and that's a big sea change in this industry.
Why, and did your reporting suggest they balked at the price ultimately? Is that what happened?
Our understanding was, based on the conversations around this, is that price may have been an issue, but the conversations were so preliminary and so early between Netflix and Roku's advisors and Roku's team, it got to the point where Netflix realized, okay, we don't really need this asset, because, as you know, Roku spun out of Netflix. It was actually incubated there, so there's a lot of close relationships there. That being said, we know they're sensitive on price. They've gone on the record. Ted Sarandos has said repeatedly, we are disciplined buyers. We are not going to overpay for an asset. You saw that when they walked away from Warner Brothers. And the other thing that we reported, which Netflix, of course, came out and denied, and we can talk about that, is that they are one of a number of media companies interested in Lionsgate. That's one of the last independent studios out there. But again, there's this paradigm that they face now. They used to be builders. They still are builders, great builders. But now in this ecosystem, in this M&A ecosystem, and in this tech ecosystem, they have to be buyers too.
So Netflix did deny it. What did you make of that? bad?
Well, I think if you're a smart buyer, you're going to deny anything. The reality is, they were denying Warner Brothers. They repeatedly, on the record, were saying we have no interest in getting into legacy media. We have no interest in getting into a studio. We don't think big M&A is the answer to anything, up until and through the sale process. I'm not saying that they're lying. I'm not saying that they're not telling the truth. A company spokesperson went on the record and told a trade publication, hey, we're not going to buy this asset. But again, our point wasn't that they are actively interested in this asset. Our point is they are one of a number of media companies who have been at some point interested in this asset. Should Lionsgate go up for sale, anyone in their right mind is going to take a look at that asset. It could be a Netflix, it could be an HBO, it could be a Comcast, because there are very few studios left that could be up for grabs.
Well, I wanted to ask you about that. I mean, Lionsgate strategically, what hole does that fill for Netflix?
Content.
Yeah.
That's it. If you think about where Netflix sits now, they're competing on originals with everyone else. They have to spend billions upon billions of dollars a year on global content, right? The goal is to have a hit franchise in every language for them. And that's not easy to do internally. That's not easy to do when you're speccing scripts out. When you have a great library like Lionsgate that's on the market, why not take a look? And I should be clear, Lionsgate isn't actively marketing itself, but everyone knows everyone in this industry. Everyone talks informally and casually. And there certainly is a lot of pressure on Lionsgate to do something soon.
When Netflix was targeting WBD, what were they targeting there? HBO, CNN, the studio, what was it?
They didn't want CNN, and they were very clear on that. We don't want the CNN business. That was the whole, remember, complicated sort of Texas two-step, that's a bankruptcy term, but the two-step that they were running, which was we were going to spin off the linear networks. That's not just CNN, it's a grab bag of global assets and global channels. And Netflix was going to keep just the studio. So that's Warner Brothers, the iconic studio, and HBO. That would have given them a larger platform, obviously, but also huge amounts of content. I mean, if you think about the exclusive content on HBO, it's incredible. We're talking about The Sopranos, we're talking about Game of Thrones, we're talking about some of the most iconic franchises ever. So again, Netflix's interest in Roku was surprising to me. They have a great tech stack, they can build it themselves, they're in a lot of homes. Warner Brothers, a content deal makes total sense. That fills a hole that will always be there for any player. They need more stuff, more people to be watching more stuff.
When Netflix walks away from WBD and investors cheer, what did that response tell you?
I would actually caveat, investors did cheer. They were happy that Netflix was disciplined on price, but it also betrayed a fundamental worry on the street. If you look at where Netflix is trading now, it's still below where it was when it announced it was bidding on this asset and was going to buy this asset. And that's because for years they have been the unassailable king. They've kind of been a black box, right? We don't get detailed viewership data, we don't really know how individual shows are performing, and they've taught the street to reward it for growth. Well, growth for all players is slowing and getting more expensive, and so Netflix's pursuit of Warner Brothers was seen in many camps as a concession that their build model was breaking down.
In other words,
would break down.
In other words, Netflix shareholders, you're looking at this, and on one hand, you could say, well, you're a big company, plenty of cash, go after it, do the M&A.
Absolutely.
You're saying a lot of folks are saying, well, hold on, is that because you're worried about organic growth?
Exactly. Yeah. What does that say about the underlying business? The great comparison is the cable industry's unwillingness to say cord cutting for years. Every exec knew it was an issue, and it wasn't until that iconic call, the Disney earnings call, where Bob Iger finally acknowledged that cord cutting is starting to hit our business. I want to say that's 2014, 2016. We're more than a decade out there. No one questions that. Every linear company has tried to rejigger their model. Is Netflix at that point? Absolutely not. But there is an understanding, I think, for people in and around the company, right? Their advisors, internally, observers, that at some point their model needs to shift. It needs to go from we are just going to do this ourselves to we will take growth and assets however we can find it. Because culturally, as you know, they're very idiosyncratic. That's always been their issue. Big M&A is hard, but Ted Sarandos publicly has said he's very confident that they're going to be able to do it.
Ron, great story, great reporting. Thanks
Appreciate
for coming in.
Thanks so much. My pleasure.
Coming up, we'll check in on some of our top trending tickers, including Accenture and Pfizer. That's next. Now time for some of today's trending tickers. We are watching Accenture, Pfizer, and Kroger. First up is Accenture, the consulting giant. Shares falling sharply today, down by nearly 15%, and that's on top of some weak performance this year already, down about 50% going into this. The company out with its numbers today, and analysts saying there's not necessarily anything in here to reassure them that consulting as an industry is not threatened by the rise of AI. The company's forecast for current quarter revenue is below what analysts had been anticipating. It also said there was a 2% drop in new bookings for this past quarter. At the same time, the company's announcing an acquisition. It's going to buy a majority stake in a company called Dragos, which is a cybersecurity company, for a total enterprise value of about $4.2 billion. So expanding its reach in the cybersecurity side of the house, but not helping the shares in today's session. We are also watching Pfizer, which has announced a management change. Dave Denton, the chief financial officer, is going to be leaving as of August 15th. Pfizer says that is because of a professional opportunity in consumer goods. And they're appointing an internal candidate as interim CFO while they look for a replacement here. But analysts are questioning whether this is going to affect the outlook for the company at a time when the market is awaiting new obesity drugs potentially from Pfizer. So that's something to keep an eye on here as we're watching that stock. I'm also keeping an eye on it on our Alpha Space platform here, as we see that the stock is, not done a heck of a lot over the past year or so. Those Pfizer shares, as you can see, not much change. This year is a similar story. And then on the right side of my screen, I'm looking at sort of some of the fundamentals for the stock, in particular towards the bottom, looking at the 1-year target estimate. So average estimate of analysts who track the company, 29.19 here. The range is from 24 to 36. And how that compares with where the stock is trading right now, it's right around $25. So analysts are predicting some upside here for Pfizer, even as it has been struggling a bit. So we'll keep watching that, see if there's any upcoming CFO news that turns it around, as well as news about any obesity drugs. And then finally, we are watching shares of Kroger as well, the grocery store chain coming out with its earnings, and the forecast leaving something to be desired in the eyes of investors. Second quarter adjusted earnings, the company says, going to be about in line with what they were a year earlier. Sales in the second quarter going to be little change compared with the first quarter, as consumers, it says, continue to be under pressure. Inflation, input costs going to potentially rise as the year goes on. And Greg Foran, the CEO of the company, says we do not need to be the lowest price retailer. We need to be more competitive, more consistent, and easier for customers to understand, making those comments on the conference call as those shares fall by 6%. And as we head to break, we want to take a look at a live shot of downtown New York. That's where thousands upon thousands of Knicks fans have gathered to watch their New York Knicks and celebrate them on the parade there. And you can see some of the Knicks and Knicks fans gathered on the buses there, making their way down the parade route. But New York City jammed up and very excited on this Thursday morning. More Market Catalyst coming up. Federal Reserve Chairman Kevin Warsh struck a more hawkish tone at his first press conference. At least it was interpreted that way, setting investor expectations for at least one rate hike by the end of 2026. My next guest still expects the Fed to hold rates steady. Matthew Lazzetti, Deutsche Bank chief U.S. economist, is with me now. It's great to see him, Matt. It's been a minute. First of all, I'm curious if you would give a grade, a letter grade, to Kevin Warsh on his first press conference.
Yeah, I thought it went well. I think there was a lot of changes to the statement and the forward guidance language and the way in which he communicates and the tone. But I thought he probably achieved what he wanted to coming into this meeting, which was, one, detail what is new and changing at the Fed. He talked about these 5 task forces that he has out there that's going to be investigating a variety of different topics. 2, indicate that the Fed is committed to price stability and that they will do what they have to fix the inflationary problem that we have here in the U.S. And then 3, change the way that the Fed communicates, and that's getting rid of forward guidance, not really telling markets about when and where the Fed is going to be changing the policy rate as we look ahead. And now that's injected some volatility. It's led to higher interest rates at the front end of the curve. But I thought he probably achieved what he wanted to coming into that meeting.
So if the market is sort of pricing in at least one hike now, and if the interpretation was a little more hawkish, why are you still thinking that it's possible that there will not be hikes?
Yeah, I think it's a great question. I think over the past month or so, we've been building a case for why the Fed may need to raise rates. One, we are more worried about inflationary pressures. We think they are more demand-driven. We don't think they're only about tariffs and the energy price shock that's going on. 2, we actually think that the Fed might be accommodative at this point in time. Financial conditions are very easy, and the Fed funds rate is below where policy rules would tell them that they should be. Now, why don't we have hikes in our baseline outlook at this point? We wanted to hear from Kevin Warsh. We wanted to learn more about the new Fed's reaction function, and so we'll have to internalize that into how we're thinking about things. But also, your ongoing, you have a decline in energy prices that's taking place that is bringing down inflation expectations. Headline inflation over the next several months at least should look a little bit more positive. But I think it's clear from yesterday the risks are that the Fed may need to raise rates this year.
When you look at those various task forces that he created to attack, I mean, it's clear he wants to change up the Fed, right? In pretty dramatic fashion, it feels like, at least tonally. The statement was shorter. He said much less. He's come out with these task forces. What do you think that most, if you were making the decisions here, what do you think most urgently needs to be tackled at the Fed?
Yeah, I think you're exactly right. I think the statement went from about 340 words down to, I think, close to 130 words. It looked much more like a Greenspanian statement from the 1990s or early 2000s. We've lost forward guidance. I think Warsh has been very consistent on the view that forward guidance is not actually a positive thing for the Fed to be giving. I would focus on 2 of the task force that I think are most interesting and urgent and will have most impact. One is on communications. There, I think they'll be looking at their various communication strategies, including the summary of economic projections and the dot plot, which gives the projections for the Fed funds rate. My baseline expectation would be that the dot plot goes away, that we don't see the individual dots, that we don't have this focus on the median of those projections, but that we continue to get the summary of economic projections. The second, I think, most interesting and impactful will be on the balance sheet. They're going to have a task force focused on the balance sheet, both when and by how much might they be able to reduce the size of the balance sheet, and even if they should. We know from kind of a long-term perspective, Warsh has been focused on the balance sheet. He thinks that it is a driver of inflation. He thinks it's a driver of inequality over time, and so his preference is to reduce the size of the balance sheet. We will learn more about how they'll do that over the next several weeks.
Do you think it's the right decision to get rid of the dot plot?
I do. I think the market is over-focused and emphasized and coalesces around the median dot in an inappropriate way. I think that's a very imprecise forecast from the Fed and projections, but the market focuses on it significantly. When the Fed began to introduce their own Fed funds rate projections, what they showed was a central tendency and a range for those projections rather than the individual dots. And I think it would make a lot of sense for them to go back to that formulation. It would give us, the market, households, businesses, a view on the overall trajectory of where policy would go, but without the downfall of being overly precise on the median. So I think if that's where we end up, it would actually be a positive outcome from a communications perspective.
Matt, it felt like the pendulum swung really far yesterday, right? From the Powell Fed, from a lot of communication to very abruptly, very little. And understanding that the new Fed chair does not want to provide forward guidance, but he also declined to provide the framework, right? Like, how is he even thinking about it? How is how's the committee thinking about it? And do you think that's a mistake? It sounds like maybe we'll get it when the task force work is done, but do you think it's a mistake to not provide, to make this such an abrupt change?
Yeah, look, Kevin Warsh promised regime change at the Fed, and one area of that he promised that regime change was in communications, and we got exactly that. I think he's right to say that at certain points in time, and maybe most of the time, forward guidance is not beneficial. We know that it can be beneficial, for example, when the Fed is stuck at the zero lower bound, and you might want to ease financial conditions a little bit more by committing to not raising rates over time. But oftentimes, it's not the case that the Fed knows a tremendous amount more than what markets or outside economists might know, and so they probably don't want to over-communicate. I think you highlight the real issue, though, is if they're not going to be providing forward guidance, and they're also not going to be giving us really much information about their reaction function. How will they change in response to incoming data? That leaves kind of a void for markets and economists like myself it makes it more difficult for us to predict where the Fed is going to go. Now, the implications for that might be greater volatility in markets. It might be that you need to build in greater risk premium on risk assets, but also in bond markets. And so yields overall might be higher. Now, that's not the reaction that we've gotten over the past 2 days. I think the market at the long end of the curve has taken down interest rates as the Fed is committed to price stability. But over the longer term, if the Fed is sustainably pulling back from forward guidance, those could be some of the market implications that I would look for.
Matt, something I'm sort of thinking about before and then after the meeting yesterday, and maybe hopefully I don't know if we have enough time to get into this. It's a pretty thorny issue, but how important is the Fed at this point, given our modern economy, given its importance in markets? How do you think about that question?
I think the Fed is critical for the economy and for markets. They really set the baseline economic conditions through the Fed funds rate, which percolates out the yield curve, is a key determinant as you think about risk asset markets for equities and credit and bond markets. So I think the Fed is critical, and they will continue to remain kind of a critical part of the overall economy and economic impact and market impact. Now, the way in which they are doing that is clearly changing. No longer do you have a Fed that is looking to over-communicate, to guide, to promise where they're going to be heading in the near term with monetary policy. And so that will change how risk assets and bond markets, et cetera, kind of respond. I think there's probably a period here where we have to learn exactly how that's going to work its way out. And there was some volatility in the markets yesterday. But overall, the Fed will remain critical, I think, for the markets and the economy. And I think Warsh very clearly understands that. He emphasized yesterday price stability within his press conference. He mentioned that on a number of occasions and said that the Fed is going to fix the inflation problem here in the U.S. That would be a great outcome if we were to be able to bring down inflation substantially in the absence of materially weakening the labor market.
Matt, good to catch up with you. I could talk for much longer about this, but we got to leave it there. Thank you so much for your time. Appreciate it.
Thank you.
That is it for Market Catalyst. I'm Julie Hyman. Everybody enjoy the long weekend. I'll be back on Monday.